Good afternoon, everybody. Welcome back to another episode of Mortgage Matters. And guess what? It's episode 8, and we've got the mortgage master himself, Christian Babcock from the Loan Depot, back in the hot seat. Today, we're diving deep into the juiciest and freshest mortgage news out there. So whether you're a future homeowner, seller, or realtor, we've got the details you need to make your decision-making process easier. Ooh, there goes my camera. All right. Okay, so welcome to episode 8. Some technical difficulties there, huh?
I'm telling you, it's been a rough Friday. How are you doing?
I think it's the weather outside that is just causing all the craziness.
Yeah, I'll take that. Yeah, my camera's all messed up over here.
I have a new camera on here right now, and that's what's causing my laptop to go back and forth.
Oh, gotcha.
So, good afternoon. How you doing?
I'm good. How you doing?
I'm doing good. So, I wanted to just kind of cover some mortgage news as we usually do. So, can you kind of clue us in a little bit or give us some details about what's going on this week? I know obviously every week there's something new happening, so maybe you can kind of give us some information. I'm like stumbling on my words today. What the heck?
Well, I've been told by some of my audience that I say like 1,000 times on some of these calls, and so I'm trying to be conscious of that because it's completely unconscious. I don't even hear myself saying it. But since people brought it to my attention, all of a sudden I'm like, oh my God, I am saying that a lot. So we're gonna have to run a count on how many times I say, So
I feel like you were just about to say it and you couldn't.
It's so hard.
All right. So mortgage news. What's new this week?
I mean, really nothing major in terms of needle movers. I mean, there's big news on the stock market if you're watching NVIDIA and what's going on with AI and stuff like that. But mortgage kind of related news, economic news has been pretty light this week. The last couple of weeks, though, we saw an uptick on 30-year fixed rates approaching back up to 7%. That was really the hotter than its expected inflation reports and job numbers that came out, which were expected to be a little cooler than the previous month in the year, and they actually in turn came out hotter, which is not good for mortgage rates when we're looking at them in real time. So not the end of the world, but it's the Fed is reacting and not really, they're looking at when they're going to try to time cuts if they're going to cut this year. So there, some of the headlines that are out now that are saying they're in no rush to cut. So, and I just said, and we'll see.
I just said you. You got me doing it. December, November, December. I vividly recall all these headlines coming out. There's going to be 6 cuts in 2024, and I believe it was supposed to be I think like right around this time, like late January, early February. We're almost at the end of February, but 6 cuts, and now here we are 2-3 months later, and we're not in any rush to cut rates.
Well, the Fed's always been saying that. It's Wall Street that's creating headlines, and economists and forecasters, all of which are never wrong and never right. But the Fed Powell's been saying that at every press conference that they're going to wait for the data. They're not going to react too fast. That message really hasn't changed. So when we were getting better than expected inflation numbers towards the end of last year, the hope for earlier cuts came back into the headlines. And I personally, and I'm no economist, thought that they were going to cut in March, but a lot of people apparently did. And that's, causing things to kind of turn around a little bit. But again, it's not getting out of control. It's not 8% like where it was in November. We still have 6s in front of rates right now. But what is running away more than anything else, our home prices are still going up.
I know.
Significantly.
I mean, to be honest with you, man, it's not even the prices. It's and we'll get into this a little later when we start talking about absorption rates and such, but like I'm putting offers in, and now when I have conversation with buyers, it's like, all right, listen, you have to be ready to put in, a minimum of like 5 to 10 offers, depending on the community they want to buy in. Like some people only want to be in, really good school districts. Some people don't have kids, so they don't necessarily have to worry about the school districts. But like you have to be ready to put in like 5 offers. And you see, right? You and I are talking, and I'm like, okay, I need an offer for this property. Same client, I need an offer for this property. I'm sorry, I need a pre-approval for this one. I need a pre-approval for that one. It's
right before this call. I mean, I'm dealing with a client right now. I mean, she looking at a house. It's listed at 690. She's asking me to run numbers for it 720 and 750 in anticipation to getting to those numbers. And depending on the market that you're looking in, that might not be enough to get that house.
Yeah.
So you gotta be prepared to be.
I had a client offer $60,000 above asking price and did not win.
Right. I've had people well over 100,000 over the asking and not get it. And then it's we try not. We don't want to discourage people on these calls. We certainly want to encourage people to be buying, but we also need to be preparing people for the reality of the market that we're in.
Very true.
We are in a fierce sellers market, which means the sellers hold the keys. The sellers have multiple offers on their property the minute it hits the market. In some cases, before it hits the market. I see agents putting coming soon on the MLS, and there's offers already being presented before it's even on, before the first open house is done.
Unseen, they're offering.
Right. So you just have to be, again, working with the right team, the right people that can negotiate, the ones with the experience, that are going to get you in the door and get noticed by the seller.
I got to be honest with you, Christian. I've submitted, at least 5 offers in the past probably 7 days, and all of them have your logo or your name. And 90% of the people, at least 90% of them, okay, cool. I know it's Christian. I know it's Loan Depot. I know that they're not just giving out, toilet paper to people, so that way they can, go out.
I appreciate the plug, because I'll be honest with you, I put together a couple deals just in the last couple of weeks, speaking with the listing agents, knowing that we're going to close that loan, knowing my reputation in this area, and feeling more comfortable accepting that offer because of who's doing the financing is a big play. And the one that I'm talking about just got an accepted offer with 5% down on a $900,000 house. Yeah. So those. So again, we don't want to discourage people with the low down payments from trying, because it can happen for you. It's just got to be presented the right way, and the price is got to be there.
So assuming that, like I said, I'm prepping the buyers to say, hey, don't get discouraged. It's going to take 5 to 10, offers, and you got to come in strong. You got to start thinking about, like, we're not just walking into an open house and just doing a once around and leaving. Like, I'm actually there with them, and I'm looking. We're going into the basement, and I'm looking, because of my experience. I've been doing this for so long. I could look at a boiler. I could look at beams running across and see, like, I know exactly what I'm looking at. So that way we could go into, like, okay, listen, we're going to do an inspection for informational purposes only. We're going to, make the offer more attractive for the sellers and packaging it all together. So it helps having a reputable lender, right? So with your Loan Depot and pre-approval, that helps. And then obviously working with the right realtor that can kind of help you and save you money in certain areas.
Right. No, exactly. Because you've been down the road before, and also having a good reputation amongst other realtors as a realtor.
Yeah.
Them knowing you. I know, some of the top agents, they're putting deals together off market, amongst each other before they're even hitting the market, because they know each other and they know how each other works, and they're more comfortable working with our area. I know this agent. I know his clients always come qualified. I'm not going to have a problem with my seller closing. This is when I've been saying it now, multiple calls. This is when reputation in this business matters on both of our sides.
Yeah. And so just to your point, being able to communicate with these agents. So like I'm going and I'm doing I'm showing listings, and I'm calling the agent before I get there. Hey, what's up, Joe? Like I got a client. They want to go look at it. And they're like, all right, cool. So it's coming from Steve. So I know that he's not just out here wasting his time. And those relationships absolutely do matter. I agree 1,000% on that.
Yep.
All right, so buyer versus seller's market. The topic of today, just to kind of reiterate, is timing the market. And I kind of asked you this earlier. So, I mean, I'm just going to ask you straight up. Like, Can a buyer/seller time the market?
I mean, if you have a crystal ball, yeah. But I mean, aside from that, no. I mean, you really a lot of people have made a lot of money based on just pure luck of timing the market. And a lot of people have lost a lot of money, by just being on the wrong side of that. And people that made the money didn't have a special gift. The people that lost the money weren't losers. It just is where the market was, what the market of the moment, when they bought, when they sold, if they made money, lost money. The one trend that is always factual is that in real estate, especially in the long term, in our area especially, you will not lose money
because it's a big city.
Right. Population, big city, inventory, supply and demand. We always, because of the dense population, there's always some demand. It's whether or not it's a ton of demand or a cooler demand. But in and outside of New York City, the market's always been extremely healthy and will remain that way. But again, it's really just sometimes luck. And if you're looking at real estate as a short-term investment, that's when timing the market is, if you're an investor, if you're a flipper, things like that. Most of the people that we're talking to are either first-time home buyers, maybe second-time home buyers that are looking to get into a good school district, raise a family, stay there maybe 10, 15, 20 years or more. Those are really our audience on these calls mainly. Yep. But I mean, we can certainly have breakout calls specifically for investors and things like that, or home flippers and all those types of things. But if you're looking to buy a home to stay and raise a family and grow roots on, you're not going to lose money in the long term.
It's interesting you say that, right? Because I remember hearing Gary Keller last year at Family Reunion, and he said that the number one question that realtors get, and I get this all the time, is now a good time to buy? And what he always said, and now I've used this ever since last year, because, listen, you don't want to advise somebody the wrong way, but I always tell people, what's your exit plan? How long do you plan on being there? Are you only going to be there for 2 to 4 years? Or if you're going to do at least, a 5 to 10 year sort of run in this house, then it's really hard to get hurt, because you're going to take advantage. Your house might, right after you buy it, it might go down in value a little bit, but it's going to circle back around and you're going to hit that cycle. So I agree 1,000%. Like, if you're there for the long term, then yes, you should be fine, and there shouldn't be any issues as far as buying and then losing value, because the markets, they just like this, up and down, up and down.
Well, it's historically always up. It's just there's bumps. There's some corrections. There's the last recession that we went through. I mean, that was a bubble, and that bubble was created by bad mortgages and Wall Street bets and all that other stuff. And that was amazing. And that's in our career lifetime that everybody remembers, and the repercussions of that were a lot of foreclosures and short sales. Places like Las Vegas and Florida have lost as much as 50% of value of properties there, because those places were getting overbuilt. Areas around here, some places lost 30-40%, but there were some markets especially in Westchester and in and outside the city, that only lost 10%. Yeah. So each little market is its own thing, but where there's more space to build, those markets get hit a little harder in a downturn, because then builders are holding on to too much inventory, and they're discounting those homes. People would rather buy a new home at a discount than a used home at a discount. Yeah. So that's where those markets got hit harder in the recession. But that's not what we're seeing now. We're not seeing a bubble that's being created by bad mortgages. We are just seeing supply and demand and affordability. That's those fundamentals have always been there. The prices are being driven up because people can afford it. They might be uncomfortable, they might be a little above their budget, but they could certainly afford it. And we're screening and checking all their documents and pay stubs and W-2s and proving that they can afford these mortgages. Yeah, and their plan is to refinance when rates go down, and they will. It's not a matter of if, it's when. But it's maybe take a little longer than expected, but they will go down, and people will refinance and have equity in their home and be in a better position than they are now.
Marry the home, date the rate.
I try really hard to not say that. It's an overused cliche at this point. But yes, it is very, very true. Especially if you're using the house to raise a family. I mean, myself included, my wife and I bought our house before we had any kids. It was a bigger house than what we needed when it was just the two of us. Now we grew into it. We have 5 kids. And we're happy where we are. And the value has gone up exponentially by accident. I didn't time the market in the town that I live in. I wasn't saying, I'm going to buy there because that market's going to go up 20% in the next 2 years, or it's going to go down 20%. I had no idea. I knew that we were married. We're planning to have kids. I wanted to be where I wanted to be. And the price of the house was the price of the house then. And I was able to afford it then. So I bought it then. And I'm still here today.
Yeah, I think that long-term planning has to go into buying the house, right? Like, for example, just to think of you, for example, it's like when you bought your house, right? Like, you didn't have any kids, am I correct?
Right, 0, right.
But you had extra bedrooms, and you're like, you know what? I'm gonna be here. This is where I want to raise my family. So
right. That was our plan. We're gonna grow into the house and stay. I wasn't planning on selling it, flipping it, making money on it. It was, this is where we want to be for the foreseeable future. We didn't know how many kids we even wanted. We just knew we were going to have kids, or when we were blessed to have kids.
Yeah.
But that was our plan.
Interesting. So just to kind of go back to some of the things that you were saying earlier, as far as like supply and demand, and a term that gets thrown around a lot is absorption rate. And it gets thrown around a lot, I think, in our industry, but buyers and sellers don't necessarily understand it. So can you kind of give us a brief overview on absorption rate and what that exactly is, and how people are using, or how we use it as industry insiders?
Right. So we look at it in terms of if realtors stopped listing homes today, how long would it take for all the houses in a particular market to be absorbed, to be bought? So they look at a 30-day timetable. How many homes went into contract in the last 30 days? How many homes are listed in there? And so they can gauge how long it would take to absorb all the homes in that market.
Okay.
So a seller's market is essentially when there's anywhere from 0 to maybe 3 months of inventory in the market. Once you hit 4, 5, and 6, it's kind of flat. It's not necessarily a buyer or seller's market. Once you get over 6, 7, 8, 9 months of inventory, it becomes a buyer's market. And the reason for that is supply and demand. When there's more supply to meet the demand, values and prices will go down, because buyers now hold the keys to negotiate with a seller. Because if that house has been sitting on the market for 6 months and you're the only buyer that comes along and you offer 10% below list price, you might get it because the seller wants to move. When the house is listed and there's 10 offers in less than 24 hours, the seller gets to choose who they're going to sell the house to. And that's when the seller's concessions go out the window. Unfortunately, the lower down payment people, sometimes get pushed out. But that's also what drives price. So now you have 10 people offering at list, and one person says, all right, I'm offering the list price. And the agent says, well, there's a higher offer. That person goes up. And they say, oh, there's another higher offer. And that person goes up, and they go up, and they go up, and they go up, and they go up until the other 9 back out. One person who remains is getting it, and that's what drives price. And that's in any market, on any good or service is supply and demand.
Yeah, I mean, it's any sort of product, right? Any sort of product is supply and demand. Right? Like I always like to think of, like, because I've heard this before, is like a gallon of milk, right? So like if when the pandemic was happening and it was like, all right, there's a shortage of tissue paper, so everybody went out and bought toilet paper, and then all of a sudden there's no toilet paper, so they were boosting the prices up of the toilet paper, and it's just I tell people, like, you just have to know basic economics.
Right.
Like, this is not like rocket science. You have to kind of know what numbers to look at or what data to look at, know how to look at them, and then make an informed decision. And back to the topic of the conversation is, there really is no way to time it. You have to kind of look at your life and where you're at. Like, for example, when you bought your house, right? You just got married and you knew that you wanted to raise kids. That was what you saw as your life. So you know what? This real estate decision makes sense because it checks a lot of the boxes. Now, if for some reason a couple gets married and they say, oh, well, we don't want kids, then maybe they don't want to buy a house. Maybe they're good in a condo or a co-op or whatever the case may be. So I feel like people just need to kind of always understand the long-term vision for themselves. And there's a lot of people out here who don't know what they want to do in 10 years, 20 years, 30 years.
Right.
Well, for your average person,
and plans change. People get divorced, people get sick, they die. I mean, that's all part of the equation. But with all things being considered and where I am right now and what my 5-year, 10-year plan is, like that's what I've always looked at,
Yeah.
and then, but you obviously can't plan anything that's going to happen in the future.
I wanted to throw something at you, and it was it's sort of a new sort of thing I'm kind of playing with, and it's debunking mortgage myths.
Okay.
So I'm gonna kind of just make a statement, and you can kind of tell me if it's truth or if it's fact or fiction, and kind of what you think about it.
It's gonna be like a lightning round. I have like 30 seconds for each one. Like, what do we?
Yeah, exactly. There you go. That sounds about right. We're still figuring this thing out, right? So, all right. So you can never pay off a mortgage early. Fact or fiction?
That's fiction. You can pay off a mortgage anytime you want with no penalty. There are some prepayment penalties on investment loans, things like that. But as a primary residence mortgage, conventional loan, there are no prepayment penalties. Even extra payments come right off principal. If you win the lotto, you pay it off in full. A refinance is actually also paying off a mortgage early because you're taking a new loan to pay off the old loan. So that's also an early payoff, and there's no penalty.
Gotcha. Okay. You must have perfect credit to qualify for a mortgage.
Fiction. You need to have credit, but it doesn't need to be perfect. There are loans that go down as low as 500 credit scores. Credit goes from 450 to 850 on the FICO 9 model. So you definitely do not need perfect credit. There are loans available for people with challenged credit for sure.
Gotcha. Okay. FHA loans are for borrowers with no money and poor credit.
Also fiction. I've had people that do utilize FHA loans for various different reasons. When you compare an FHA loan to a conventional loan, there could be reasons why one is better than the other. It usually comes to rate and payment. But no, it's not only for people with low down payments. I have had people that with 10% down, 15% down. Once you get to 20%, FHA doesn't make sense because it still comes with PMI. Gotcha. So with anything less than 20%, FHA and conventional can be utilized. And that's really my job, is to look at them side by side and make the recommendation to the person which is the better loan for them.
Yep. Okay. Mortgage rates are the same for every lender.
Fiction. They are very close. Again, conventional 30-year fixed loans that are backed by Fannie, Freddie, FHA. Pretty much every lender is within 1/8% of each other because they're all looking at the same product. They're all looking at the same markets that change those rates, and they change in real time. But you can find there's definitely different products out there. I've seen adjustable mortgage, things like that. You may have a credit union or somebody that's offering some kind of special on a HELOC or something. But for the most part, conventional FHA rates are very close to each other from bank to bank. And the reason that's kind of become mystified is people might speak to one place on a Monday and another place on a Friday. The rates can be vastly different, but they didn't realize, or nobody explained to them, that was really just a change in the market. Mm-hmm. It wasn't necessarily that Bank A was any better than Bank B. It was just that when you spoke to them.
Yep. All right. So last one for today. I have to use cash to buy a fixer-upper.
No, definitely not. You can get mortgage. you can get loans for fixer-uppers. We do a lot of them. Traditional rehab loans, both conventional and FHA rehab loans. You can actually buy a house in any condition, and then we can add the cost to fix that up into the loan. As long as there's an existing structure there, a foundation, you can literally tear the entire house down and rebuild it with a rehab loan. Or you can use it even for stuff as simple as just replacing appliances or a roof or paint job.
So those are 5 myths, and I've got a list of like 25 more. I'm gonna hit you next week with a couple more, but these are the things that your average consumer is hearing out there, and these are the things that people like you and I struggle to answer and to let the general public know that these are not truths. They're just myths. It's just not true. So thank you for that. I appreciate that.
Right. Yeah, well, and a lot of it just comes from generational misunderstanding. You might have people that possibly their grandparents couldn't buy a place because 30, 40 years ago, you had to have 20% down or more to buy. And that's where some of those things get passed down to, and then you have generations of people that never bought a home because they still think it's the 1960s where you can't get a mortgage with less than 20% down. So that's why we're here.
Yep. You're heading out to Vegas?
Yep.
When do you leave?
Tomorrow.
All right. Well, listen, safe travels to you, my man. Okay. And thank you very much. Are you going to be back next Friday?
I'll be back Tuesday. So I'll be back for next Friday. We're going to do another one.
Sounds good. All right, cool. So I'll see you next week, Christian. Thank you so much, man. Appreciate you.
Thanks, Steve.
All right.